Monetary policy and banking regulation. So, in this chapter, we'll talk about the Federal Reserve banking system and central banks. We'll talk about bank regulation, how a central bank executes monetary policy. We'll talk about monetary policy and economic outcomes. And then we'll finish off with some pitfalls of monetary policy. Monetary policy, some of the most influential decisions regarding this policy in the US are made behind these doors. Those are the doors of the Federal Reserve headquarters in Washington, D.C., the home of the Open Markets Committee that takes on monetary policy. So remember when I talked I'll talk about it later, fiscal policy, which emanates from Congress, the Senate, and the White House. On the opposite spectrum, monetary policy emanates from the Federal Reserve. The Federal Reserve is our central bank. It's the organization responsible for conducting monetary policy and ensuring that a nation's financial system operates smoothly. In the US, the central bank is the Federal Reserve or the Fed. If you want to YouTube that, it'll bring up, there's a nice little video that introduces you as students to what the Federal Reserve Bank does from a 360-degree standpoint. The Fed is a semi-decentralized mixing government appointees with representation from private sector banks. It's run by a board of governors consisting of 7 members appointed by the President of the United States and confirmed by the Senate. Jerome Powell is not our current Fed chairman. A new Fed chairman has been instituted, has been nominated, confirmed, and sworn in. So while the chair of the Federal Reserve has only one vote, they control the agenda and is the public's voice. The Federal Reserve is more than a board of governors. The Fed also includes 12 regional Federal Reserve banks, each of which is responsible for supporting the commercial banks and economy generally in its district. What you'll notice by looking at this map, the majority of the Federal Reserve banks are east of the Mississippi. The reason is during the formation of the country and the Federal Reserve Bank, the country was mainly east of the Mississippi. As we began to traverse westward, you'll see the Dallas Fed, the Kansas City Fed, and then our 12th Fed Bank, which is in San Francisco. The Federal Reserve is designed to perform 3 important functions: to conduct monetary policy, we'll take a deeper dive into that, to promote stability of the financial system, I'll talk to that, and to provide banking services to commercial banks and other depository institutions, and to provide banking services to the federal government. My bank is Bank of America. The Federal Reserve is the bank of my bank. So the Federal Reserve is the bank of Bank America. The Federal Reserve is not my bank. Bank regulation is intended to maintain bank solvency by avoiding excessive risk. Regulations fall into a number of categories: reserve requirements, capital requirements, so the Fed can tell a bank how much capital they need to have on reserve. We talked about reserve requirement earlier, and then restrictions on the type of investments banks may make. Regulation requires that banks maintain a minimum net worth, usually expressed as a percent of their assets, to protect their depositors and other creditors. Several other government agencies monitor banks' balance sheets to make sure they have positive net worth. We have the Department of Treasury's Office of the Comptroller of Currency. We have NCUA, the National Credit Union Administration, that administers rules and regulations for credit unions like USAA or Randolph Brooks. They are governed under the NCUA. And then we have the Federal Reserve. The reason we have the Federal Reserve is this is a picture of a bank run from the Great Depression in the 1930s. The bank run is when depositors race to the bank to withdraw their deposits for fear that otherwise they would be lost. That happened. We had bank runs in the 30s, and that's when we was one of the reasons the Federal Reserve was created. The risk of bank runs can create instability in the banking system. To protect against bank runs, Congress has put two strategies into place. One, FDIC insurance or deposit insurance, and also Congress is a lender of last resort. The Federal Reserve's most important function is to conduct the nation's monetary policy. Monetary policy involves managing interest rates and credit conditions which influence the level of economic activity. The most common monetary policy tool in the U.S. has been open market operations, the central bank selling and buying treasury bonds to influence the quantity of money and the level of interest rates. The FOMC, which is the Federal Open Markets Committee, makes the decisions regarding open market operations. It's comprised of 7 members of the Federal Reserve Board of Governors and 5 voting members from the regional Federal Reserve. Open market operations is simply the Federal Reserve is either buying treasuries. When they buy treasuries, they put currency into the market. The thought is the more money I put in the market, the more economic activity I can generate. If with open market operations, they are selling treasuries in the market, that means they're selling treasuries for dollars. They're extracting dollars from the economy. So the theory being, if I take money out of the economy and the economy is hot or growing way too fast, it would slow economic activity. So this is an example of how open market operations increases the money supply. So example A shows that Happy Bank starts with 460 million in assets, dividing among reserves, bonds, and loans, and 400 million in liabilities in the form of deposits, with a net worth of 6 million. Example B shows when the central bank purchases 20 million in bonds from Happy Bank, the bond holdings of Happy Banks falls to 20 million and bank reserves rise to 20 million. However, Happy Bank only wants to hold 400 million in reserves. So the bank loans out that extra 20 million in reserves and its loan rises by 20 million. The central bank's open market operation causes an expansion of money supply. That's another way money supply can be expanded. The opposite happens on the other end. So if the Federal Reserve wanted to decrease the money supply, it would show when Happy Bank purchases 300 millions in bonds. Happy Bank sends 300 million of its reserves to the central bank. The bank holds an additional 300 million in bonds. That's 300 million that's not in the economy. So at the end of the day, when they do that, this causes the money supply to decrease. A second method of conducting monetary policy is a limited reserve environment is for the central bank to raise or lower the reserve requirement. The reserve requirement is the percentage of each bank's deposit that is legally required to hold either as cash in their vault or as a deposit at the central bank. So here's how they institute policy. The greater the reserve requirement, the less money to lend out. The smaller the reserve requirement, the greater amount available to lend out. So that's another way that the bank institutes monetary policy. The bank also has a third tool, the discount rate. Remember before I said that the Federal Reserve is the banker's bank. They are the bank to Bank of America. So the interest rate charged by the central bank on loans that it gives to commercial bank. So for example, if the going rate for a car loan is 7% and Bank of America can borrow money from the Federal Reserve for 3%, then it'll borrow that money, lend that money out, and then keep the 4% spread. Now, that is expansionary policy. The Federal Reserve can also raise the discount rate. So if the going rate for a car loan is 7%, the Federal Reserve now has increased the discount rate to 10%, then it's not tenable. The bank is not going to go and borrow at 10% and loan at 7% because it's losing 3%. So that's how the Federal Reserve is effective when using the discount rate for either expansionary monetary policy or contractionary monetary policy. And just briefly, in 2008, they introduced a fourth tool, quantitative easing, QE, the purchase of long-term government and private mortgage-backed securities by the central bank to make credit available in hopes of stimulating aggregate demand. Again, let's talk some terms. Expansionary monetary policy is monetary policy that increases the supply of money and the quantity of loans. On the opposite spectrum of that is contractionary monetary policy. Tight monetary policy reduces the supply of money, reduces the supply of loans. The Fed's funds rate, that's again, the Federal Reserve is a banker's bank. So the Fed funds rate is the interest rate as which one bank lends funds to another bank. Through open market operations, the central bank changes bank reserves in a way which affects the supply curve of loanable funds. The Federal Reserve has since 1995 established its target Fed funds rate in advance of open market operations. If open market operations do not meet the Fed's target, the Fed can supply more or less reserves until interest rates do. These are just an example here. I'll leave this up for a second so you can see both contractionary and monetary policy at work with different equilibrium rates and different effects. Monetary policy affects interest rates and the available quantity of loanable funds, which in turn affects several components of aggregate demand, which we've talked about prior. Tight or contractionary monetary policy will reduce two components of aggregate demand: business investment, consumer borrowing. Conversely, expansionary monetary policy will tend to increase business investment and increase consumer borrowing for big ticket items. Again, these are two graphical examples of a shift in the aggregate demand curve, both to the right and to the left. You can see the short run aggregate supply curve where equilibrium moves from E0 to E1 or moves back on the other one. And these are just examples of the Federal Reserve instituting monetary policy affecting aggregate demand in the country. Monetary policy should be countercyclical, moving in the opposite direction of the business cycle and economic downturns and upswings. Again, the pathways of monetary policy, expansionary policy is an increase in money, decrease in interest rates, increase in investment and consumption, increase in price in productivity and real GDP. Contractionary policy is the opposite. Again, these are just other examples. What I want you to walk away with is understanding what expansionary monetary policy is. That's the Federal Reserve putting additional money by its different means into the economy. What it's saying is the more money I can put into the economy, the greater economic activity I'm able to generate. Contractionary says the less money, if I can take money out of the economy when the economy is running hot, then I can reduce economic activity. I can slow the economy back down. There we go. And if you ask me, the target is for GDP by the Federal Reserve. The Federal Reserve has several mandates. The mandates are price stability and full employment. So they want as many people who want to work, and they want low inflation. They want price stability. And so the actions of monetary policy are to that end. Full employment, stable prices. So what are some of the pitfalls of monetary policy? Banks are legally required to hold a minimum level of reserves, but no rule prohibits them from holding additional or excess reserves. So what are excess reserves? Reserves banks hold that exceed the legal mandated limit. For example, the Federal Reserve can say you have a 10% reserve requirement. Banks could say, hey, I want to hold 50% of my reserves, meaning they're going to loan out less, meaning they're going to reduce economic activity. So that's one of the pitfalls. And then the velocity, the speed at which money circulates through the economy. If the velocity is slow, that equates to slow economic activity. If the velocity is high, that equates to high economic activity being generated in the country. Let's see, that's M1, unemployment and inflation. Again, most central bankers believe the primary task of monetary policy should be fighting inflation. This vision of focusing monetary policy on a low rate of inflation is so attractive that many countries have rewritten their central banking laws since the 1990s to have their banks practice inflation targeting. Inflation targeting, a rule that the central bank is required to focus only on inflation. In this country, the Federal Reserve has a 2% target for inflation, and that is what is the cornerstone of our monetary policy. It's price stability, and that's important. So you ask me, well, why is it important? From your perspective, once you get out in the workforce, your salary may be growing at 3% or 2.5%. But if the prices you pay at HEB or gasoline is growing at 5% or 10%, that means your take home pay is worth less and less and less each year. And that means you're generating less economic activity. So I want low inflation. I want price stability because I want salaries and wages to be growing faster than inflation. And so the neoclassical model of monetary policy is simply stimulating supply. Neoclassicals feel like if I can stimulate supply, I can provide growth in the economy. Thank you very much.